This is RateSpy TV, your covert source for Canada's hottest mortgage deals, strategies, and market intel.
Welcome to RateSpy TV. We educate, we give it to you straight, and we help you get a better rate. And the rhyming, as always, is free of charge. I'm your not very secret agent, Rob McClister, and today's show is made possible by our sponsor, IntelliMortgage, the easiest way to get a mortgage online. So enough small talk, let's crack open the dossier and start spilling some intel. Here's what's happening in mortgage land this week. The finance minister has jacked up mortgage costs, ticking off some federal MPs. We'll tell you what politicians are doing about it. The gap between fixed and variable rates is widening. But what does it mean to you? And like in every episode, we spy on the juiciest rates of the week. Kicking things off is a parliamentary brouhaha over the new mortgage rules. For the past 3 weeks, opposition MPs have been grilling policymakers like a side of bacon for taking away lender competition and removing financing options for consumers. The clash comes after regulators decided to ban default insurance on various mortgage types and raise capital requirements on mortgage insurers. Now, the finance minister argues this was necessary to reduce housing risk. But mortgage finance companies, those little mice that compete with big cap banks, must now sell their now uninsurable mortgages to those very same banks at worse prices. It's kind of like trying to sell tomatoes to a tomato farmer and expecting to get a good deal. The new rules have forced bank competitors to jack up their rates roughly 15 basis points on refinances, amortizations over 25 years, rental properties, mortgages with 20 to 35% equity, and mortgages on million-dollar homes, which these days are below average houses in Toronto and Vancouver, believe it or not. So that brings us to our game show question of the week. Who has two thumbs, is watching this broadcast, and must now pay more because of the new rules? If you answered you win a brand new higher rate. Now, CMHC CEO Evan Siddall has been a vocal champion of these rules. His recommendations in part led to Finance Minister Bill Morneau enacting them without any public consultation, without equally applying the borrower stress test rules to banks, and without finding alternatives to preserve mortgage competition.
That was not cool.
Now, that's kind of like the mortgage equivalent of the MLSE moving the Toronto Maple Leafs to Texas overnight. Now, opposition MPs have had something to say about all this. Listen to MP Ron Leeper here, who makes it a little personal.
Mr. Leipert, 5 minutes.
Mr. Siddall, thank you for coming today. I must say that I cannot believe that we had about 12 hours of witnesses here, people who are in the field, people who are experiencing this every day, and you come here with a statement that basically says they don't know what they're talking about. I'm sitting here in Ottawa and I know better than they do. I don't think I've ever seen a more arrogant presentation in my life.
That was tenser than a legal immigrant shaking Donald Trump's hand. Now, Siddall very appropriately reminded everyone about the economic hazards of highly indebted borrowers. Now, Siddall did not, however, answer why his own organization, CMHC, has been happily insuring such borrowers for years. Nor did he explain why the government didn't simply throw risky borrowers to the wolves, leaving things status quo for sensible homeowners and saving Canadian families billions in interest. Now, Parliament's Finance Committee, that's the PFC if you're into made-up acronyms, will now make recommendations to the Finance Minister. And about 26 miles red tape later, maybe we'll get lucky and the government will rejig the rules, keeping housing safe, making it harder for debt addicts to get a mortgage, but preserving competition and rock-bottom rates for everyone else. In other mortgage news, we're starting to see fixed and variable rates part like the Red Sea. The gap or spread between typical discounted 5-year fixed rates and variable rates has risen from roughly about a quarter point or so to 1/3 of a point on conventional mortgages and a half a point or more on insured mortgages. Now, usually the wider the fixed variable spread, the more people get hot and heavy about variable rates. Now, not surprisingly, with the lowest insured variables going for about prime minus 1% right now, the SPY is seeing a spike in variable rate interest. But is it time to float your rate? To answer that, we direct you to the SPY's new fixed versus variable decision checklist. Click the link to the right and it'll pop right up in your lovely little browser. For those who don't like lists, here's the Coles Notes summary. If you're getting an insured mortgage and you got 3 months of living expenses saved up or more, a reasonable debt load relative to income, and solid employment, then consider variable rate, but only if you can find one under 2%. If, on the other hand, you have 20% equity or more and you're a risk-tolerant borrower, take a look at a 2-year fixed. You can grab one near about 2% or so, and it lets you re-up into a potentially cheaper variable in 24 months. Now, for everyone else, 5-year fixed rates under 2.5% are about as reliable as an AK-47 in a dust storm. And if you're not a gun person, that's very reliable. Now, keep in mind, it would take just a 75 or 100 basis point rate hike for a 5-year fix to beat your typical variable rate based on interest cost alone. It's now high time for the SPY's rate surveillance. Bond yields, which steer fixed mortgage rates, are just hanging around their 2-year highs.
Hanging around.
Mortgage rates won't rise appreciably until the 5-year yield is well above that 1.25% top you see right there. Now, in order for that to happen, U.S. rates must surge, which largely depends on Congress approving Trumpsters' Make America's Economy Great Again plan. That could take months, or even longer if Trump's head explodes from the stress of making up international incidents. The other joker in Canada's deck is oil. Oil and Canadian rates have an intimate, cozy relationship. Now, crude has also been trading sideways for months, so whichever way it breaks, mortgage rates should follow like an imprinted duckling, at least in the short to medium term. Now, at the moment, chart watchers are telling us that oil is headed up, but longer term, alternative energy and growing supply suggest otherwise. Now, elsewhere in the financial markets, rates on derivatives are implying a 0% chance of a rate cut this year. That's about the same odds of me getting a front row ticket to U2 this summer. The OIS implied chance of a rate hike this year is up to 20%, but these are odds that are not really high enough to sway anyone's rate decision, so you can safely ignore them. At last, stars and dogs time. This is where we scope out which mortgage terms are the best buys and the most unwise. Variable rates on insured mortgages are hot, folks. Oxy, acetylene torch, hot. The SPY lists insured rates as low as prime minus 1.04%. That's just 1.66% for the math impaired, and by contrast, the lowest insured 5-year fixed is 0.6 of a point higher, the biggest gap in a dog's age. Now, this makes the insured 5-year variable the star of the week. In the uninsured realm, HSBC still owns the 5-year fixed rate market. Its 2.35% rate is available on all mortgage types, even refinances, which is no longer the case at many lenders thanks to the new mortgage rules. Now, 2.35% for 5 years of rate security is a blockbuster deal in today's market, and hopefully, unlike the video chain blockbuster, it doesn't fold. That brings us to the dogs of the week. 4-year fixed rates are still the ugly mutt of the rate market. You can get 5-year rates even cheaper and flexible 3-year fixed for even less. So you want to avoid 4-year terms like cold sore until they're at least about, let's say, 15 to 20 basis points below 5-year rates. And if you're even pondering a term over 5 years, hit your head against the wall a few times and you should start thinking clearly again. Now, the SPY likes to remind fellow agents that the best term depends on your 5-year plan and risk tolerance. So keep short-term flexibility and long-term payment security in mind when choosing what's right for you. So that's the end of this week's briefing. Thank you from the bottom of our mortgage hearts for tuning in. I'm the SPY who loves you. I'll be back here in about 2 weeks. In the meantime, don't settle for a good rate when you can get a great rate. Every basis point counts, so the SPY is going to keep watching out for you.
RateSpy TV is sponsored by IntelliMortgage, Canada's mortgage rate search engine.